everybody. Thank you so much for joining us today for this webinar. My name is Samantha, and I am in Client Services here at the Retirement Group. I'm going to be moderating this webinar. You'll see me throw some useful links into the chat. They're what I call our most valuable resources. One will guide you to our LinkedIn, where you can follow us and look at all of our upcoming webinars and updates. The second thing I'll throw in that chat is a link to book an appointment with an advisor after this webinar. The third is a link to our online recording library, our education center, where you can view a full online library of all of our past recordings of topics you may find of interest to you. Today, our speaker is Wesley Boudreau, and he's going to be providing some effective strategies to navigate current market volatility and protect your 401k. He'll also explain how Treasury bonds provide a safeguard for your retirement savings. Before I bring Wesley on, I would just like to remind you that although we have extensive knowledge of Fortune 500 company retirement plans, we are not affiliated nor endorsed by any specific company. The Retirement Group is a completely independent group of financial advisors. After Wesley's presentation, he will be bringing me back on to read him some of the questions you may have entered into the Q&A box throughout his presentation. Please feel free to ask away. It's completely anonymous. We love your questions, and we'll answer as many as possible before we end today. And without further ado, I'm going to introduce you to our speaker today, Wesley Boudreau. Hey, Wesley.
All right. Thank you for that introduction, Samantha. And like she said, we're going to be talking about volatility. We talk about Treasury bonds. We're going to go over kind of our value philosophy that we've talked about in some previous webinars, but we're going to sprinkle in some information on Treasury bonds. So a lot of people have been asking about that recently. And at the end of the day, like she said, we work with a lot of different a lot of different Fortune 500 companies. Not everybody's going to have some of these options in their 401k, so give us a call. We can kind of talk about where you can review and actually mix those in or look at other options in order to diversify your portfolio. Before I get started, just a quick reminder who the Retirement Group is. Again, we are an independent financial advisory firm that focuses on working with corporate individuals, mostly Fortune 500 companies, and helping them transition into retirement. We've been doing this for a little bit over 30 years. And some of those companies we've been working with for that entire time. So we've obviously got a deep knowledge of your specific company plan information, whether it be the pension plan, 401k, healthcare retiree benefits, life insurance benefits, things like that. So any questions you have, feel free to reach out to us and we'll be happy to kind of walk you through that. But the goal is to help you understand those options. So as you get closer to transition to retirement, you maximize your benefits and decide the best day to retire to capture those benefits. And we do have offices throughout the country, so rest assured if you want to sit down face-to-face, we can probably still accommodate that, but obviously this day and age, it's very easy to have phone calls, web meetings, email, fax, whatever your preferred communication is. Just let us know. At the end of the day, the biggest thing we recommend is to take us up on our complimentary cash flow analysis. This is essentially a detailed, specific financial plan geared towards your retirement decisions. And this is where we can dig into helping you understand the differences in your company plans, help you determine the best day to retire, so you maximize those benefits. And we may come across saying, hey, you might want to hold on for another quarter to maximize your pension, or it may make sense to go sooner rather than later. Or we're also not going to shy away from telling you, hey, you need to work another 2 or 3 years in order to meet these specific goals or adjust those goals. So if you want to see where you stand, that's where that comes into play. And after we do that, we can obviously dig into helping you with the investment strategies within your 401k and outside of that if you need that help. Now, talking about inflationary pressures, we've been talking about this for the last couple of years. This slide, we've been going over it for about 2 years, talking about all the government spending eventually going to lead to inflation and then eventually potentially going to lead to higher taxes. So we've accomplished the first part of that. We've obviously seen inflation. Now in 2022, it ran a lot higher than what we probably expected. We obviously knew with all the government spending during COVID, which to be honest with you was more than we spent during World War II, and we've also spent some since COVID. But we knew that was going to drive inflation, and it obviously reared its ugly head. Last year, we saw a dramatic inflation, which in turn affected bond prices. We'll talk a little bit about that later, but it obviously affects the purchasing power of everything, where that dollar's not going to go as far. It's cost more to buy eggs, buy bread, cars, gas, anything. Pretty much everything across the board is costing more. So now the question is going to be, will this turn into higher taxes? Obviously, time will tell. Administrations change over time, but eventually we're going to have to see either a deflationary pressure somewhere down the road or looking at raising some taxes to cover some of this government spending we've been seeing. So again, that's something just to keep an eye on. As far as the retirement group, let's kind of jump into a little bit about our value philosophy, and then I'll talk about the bonds, which is the topic of this webinar. But it's important to kind of know where we stand as well. Obviously, as an investment advisory firm, we help you allocate your portfolios and manage those if you need that guidance. And we diversify it across the board between various stocks, bonds, different options within the stocks, whether it be value or growth, large, mid cap, small sectors. But on the whole, we believe a little bit more heavily in a value philosophy when it comes to investing in the stock market. Doesn't mean we don't use growth in there as well, but let's go ahead and dig into why we use value, because it's something you and I think everybody on this webinar probably does in their day-to-day life. If you're going to go out there and buy a car, buy a TV, you look at Amazon Prime Day or things like that, you're probably going to shop and try and get your most bang for your buck and find something on sale or find something that's really valued, and not just simply pay the highest price for the shiniest thing. Now some people do that, but most of us don't. So that's kind of the same situation when you look at a stock. If you're going to go out there and research a company, you usually want to make sure that you're buying a solid company. It's got a low price to earnings ratio, low price to book ratio, may pay a high dividend. And what's going to happen a lot of times, these companies are companies that have been around for a long time. They've kind of gone through that growth cycle where they've started up. They've, the question is, could they survive? They need to borrow money, and they grew and grew and grew. And then eventually they get to the point where they kind of slow down. They've kind of hit their plateau and they realize, hey, we're not going to be able to reinvest this cash as much as what somebody else could. So we'll pay a dividend, and those dividends may go up over time. So by capturing that dividend, you're essentially giving yourself a little bit of a margin of safety there, because if you're looking at stock A versus stock B and one pays a 5% dividend, and across the board everything went down 10%, you're only down 5% on that one that pays a dividend, because you're collecting that dividend just like you would collect a coupon from a bond. So this is what you need to look at as far as digging into it on your own, or ultimately employ a company like us or mutual fund managers in order to focus on finding those specific companies. And by doing so, what it's going to do is going to kind of alleviate some of that risk. It's not going to eliminate it. Again, if the market goes down as a whole, you'll still see value go down just like growth, but not as severe. And we'll kind of show you some examples of that over the past couple of decades or so. This chart, I'm going to have to zoom in because it's pretty small here, but this is going to show you kind of the comparison of value versus growth. The value is the Russell 1000 value is going to be the kind of purplish blue, and then the orange is going to be the Russell growth. So this goes all the way back to 1985, and you can see they tend to move kind of in unison, but there are some differences where obviously value is going to outperform or growth is going to outperform. But if we focus on kind of that center of the chart right here, you can see back, when we had the .com, bubble, you see growth in the late 90s moved up quite a bit. But then what happened is obviously that .com collapse through growth down below value in 2000, 2001, 2002. And it didn't really kind of come back until we went to the 2008 recession. And then at that point, growth started to actually kind of outpace value again. And we've saw here at the end of the chart that growth has been outpacing value for quite some time. And then the question was, okay, when's value going to come back with that inflationary pressure? We talked about this in the last year or two, that value would. And then obviously in 2022, it came back kind of strong. Now, not in the sense of that it outperformed. It outperformed the growth, but it's not in the sense that it was positive. If you take a look at this, this is what happened in 2022. The red is going to be growth and the blue is going to be value, represented by by Vanguard. You can see the value was, it lost a bit. It was down 4 or 5% or so versus growth being down 30+%. So it did actually do what we were talking about and did what it was supposed to. There was a flight to quality, flight to those dividend paying stocks. Now, obviously, so far in 2023, it's kind of flipped those scales because there's obviously been a rebound where eventually what's going to happen, there's going to be kind of a mean reversion with those as well. But still in the long term, we view value as a safer allocation for a larger chunk of your stock portfolio going forward. And a good quote by Charlie Babrinsky, Ariel Fund Manager, if you go back to 1926, value has beaten growth every 10-year period, except the last 10 years. So again, on a consistent scale, value tends to outperform because again, you're looking at quality companies there. And a lot of times when we've got disruptions, growth is going to move higher or lower. It's going to be more volatile in that situation. So we work with a lot of retirees. So the goal is to kind of reduce some of that volatility as well. Let's get into, actually, I'm sorry, let me back up. There's one more example we had to kind of dig into. I'll go quickly through this for the sake of time. But this is an example if you were going to actually go out and buy your own company. So kind of take this and blow up the scales to say that you're looking at analyzing a big firm that's on the stock market. But if you're yourself going to go out there, let's say maybe retired, you've been kind of piddling around for 2 or 3 years, you're bored, you want to do something, maybe you decide, hey, I want to go buy this flower delivery business and see how much that, how much I can make off of that, or if that's a good investment. So you need to go out and look at it and see how much it's worth. So in this case, this flower delivery business, it's for sale for $200,000. It's got a book value when you look at the assets minus liabilities of about $160,000, which includes 5 delivery trucks. Now that is a depreciating asset, but again, so you got $160,000 there. You got inventory of $10,000. So right now you got $170,000. You're paying $200,000 for something that's $170,000 of value. So really, you're paying $30,000 if you want to say that. The net income on there has been $30,000 consistently, and the manager has been keeping $24,000. So if you look at it that way, the assumption is if you make $30,000, you're going to get back to break even within a year or two. If you're netting or taking that $24,000, that's what's that? That's a 12% return off your $200,000 investment. So this would be kind of a value play as long as you want to do the work and run that. So you got to take that same mentality when it comes to analyzing this individual company, but usually you want to rely on portfolio managers that have the wherewithal and the team and the consistency of doing that in order to diversify, because you have to do this for company by company. And generally speaking, if you are doing an individual stock portfolio yourself, you want to have at least 20 plus stocks within that portfolio. So let's talk about the bonds and kind of what this webinar is about. First and foremost, on a lot of people's mind is, are we going to be in a recession? So let's first kind of cover what a recession is and then kind of get into some of those. Recession is one of 2 ways to look at it. One is just looking at a widespread decline in economic activity, which is the one that everybody's afraid of. And that's when we're questioning, are we going to see a recession there? The other academic is just simply 2 consecutive quarters of negative GDP growth, or GDP shrinkage, if you would. And that happened. That happened Q1 and Q2 in 2022. It also happened in Q1, Q2 of 2020, but then rebounded. So we did have kind of, if you want to call them technical recessions, but not the widespread recession everybody's really talking about and fearful of. So what's going to happen is we've seen inflation rise rapidly in 2022. It's still there. It's kind of slowing down at this point through 2023. And we're starting to see some issues with job layoffs and things of that nature, stuff that does lead towards a potential recession. So time will tell. The goal, obviously, the Fed has been to, if we have a recession, have a soft landing, not a severe one. But it is potential that we could see a recession, in late 2023 into 2024 if things don't go according to plan. So again, just keep that in the back of your mind. And we'll talk a little bit about how that affects bond yields as well. Excuse me here. So first, let's kind of cover the basics of bonds. First type of bonds we have are going to be federal or U.S. Treasury bonds. Those are going to be issued by the federal government and backed by the government. And so those are going to be considered typically the safest. We obviously had some scares in 2023 with the debt ceiling crisis, whether we were going to raise that or not, and the payability of the government. But again, we got through that. And so generally speaking, the U.S. is viewed as one of the safest investments. So you're going to have more guarantees or more safety behind those federal government bonds, which in turn means those yields are not going to necessarily be as healthy as what others municipal or corporate bonds would be as well. Now, municipal bonds are similar to government bonds, except they're issued by the local authority or the state. So let's say that maybe a county wants to build a new school system, or maybe there's a new toll road or something like that. Now they back that by the taxing authority of those counties and states. So that's where you get your security there. It's not as secure as the government because it's not backed by the central bank. They may make a mistake. They may overestimate the toll proceeds on a road, or may run into a situation where they can't raise the taxes enough to cover a school bond or something like that. So we have seen issues where there could be some bankruptcy issues on a local level, or really on a local level. So again, you have to be careful about that. Look at diversification and municipal bonds. But another reason to do that is because the tax-free status, especially in your specific state as well. Then taxable corporate bonds are what most people have in their portfolio, especially in the 401ks we're talking about. You're going to have mutual fund options which have corporate bonds in there. So this is just a bond from a company, whether it be Apple or ExxonMobil or any company out there that may want to issue corporate bonds in order to fund a new venture, a new plant, whatever it is that they need that money for. They're going to go out there and they're going to issue those bonds just like the federal government would. The difference is they're not as stable as what the government is. So you're going to demand a higher return or a higher coupon payment. So maybe if a treasury bond's paying 5%, you might have to get 7% or so from a corporate bond. It just depends upon the quality of that company. A value company like we talked about before, when it's been around and consistently shows it's got good revenue, is going to pay a lower yield than a growth company that's needing to bring in funds in order to fuel their growth. So just keep that in mind. The big risk there is if that company were to go under, then you're not going to obviously get paid from that company. So your principal is not protected in that sense. So let's talk about the potential of recession and kind of how bonds act and react to recessions. Bonds typically are going to be a good fit for a portfolio or a portion of your portfolio in a recession because, again, there's a flight to quality. Plus, they're going to give you that yield, assuming they stay there. So we talked about the corporate bonds. There's a risk of that potentially a specific company maybe going under. You spread your risk out by using mutual funds or ETFs usually. But with the federal government, there's not going to be, or we hope there's not a risk of that going under. So what's going to happen is, you're going to get that coupon. Let's assume you're getting 4%. Every year, that's going to still come in. So people are flight to quality. They would look for those. So that would also in turn raise their principal. So let's say you bought a bond. Normal denominations are $1,000 par. So you bought a bond for $1,000, and let's say it's paying 5% coupon, and then we have a recession and interest rates start to go down, and people want to buy your bonds. Well, if the current interest rates on new bonds are 3.5% or 4%, then you can get a premium on that. So people will pay you more than that $1,000 you bought it. So that's an increase in your principal and your premium there. So that's another issue we see with bonds. And the opposite is what happened in 2022, where we saw inflation rise. So everybody was sitting on, the banks as well, were sitting on these low, 1.5%, 2%, 3% bonds. Whereas now you can go out there and buy one that was paying you more. So nobody wanted that. And if the banks had to sell it, they'd have sold at a discount. So instead of getting their $1,000 back, they might have gotten, $950 or something of that nature, which is where we led into some of the banking trouble at the beginning of 2023. So there are some risks associated with bonds in recession as well. We just talked about the aspect of knock on wood. Hopefully we're okay with the government bonds, but there are going to be concerns with municipal bonds potentially, and also corporate bonds. If a specific company were to go under during recession, then they may not have enough money to pay back all their bondholders. They're definitely not going to pay back the stockholders, but they may not have enough money to pay back all the bondholders as well. And high yield bonds, typically what you're going to do is, because of that specific assumption that there's more risk there, their overall yields and prices may go down a little bit too, because there's again a flight to quality. People are not going to be gravitating towards those high yields if a recession is looming. So I apologize. So how do we manage bonds in a recession? So first and foremost, you want to kind of review the duration. I'll talk a little bit about the yield curve here in a second. But bonds that are going to be out farther on the yield curve, 20, 30-year bonds, there's going to be more risk to those in the short term as far as price fluctuations if we have a recession. And then on the flip side, the short term, you're going to, you may have those mature throughout the course of a recession. So you may have to go out there to the market and get something new. Generally speaking, if you're not going to do these on your own, I talked about diversifying a stock portfolio, 20 plus individual stocks. To be honest with you, most recommendations, if you're buying individual bonds, is to have 100 or more in your own portfolio. So it's really, a lot of times it makes more sense to look at mutual funds or ETFs for that diversification and also the professional management. And keep in mind, it's not just really a buy and hold. for most of those mutual funds, they're going to be consistently buying and selling those. And as the different bonds mature, so as rates move up, you'll start to see a higher yield in there as well. Very sorry. You also want to look at choosing quality. So again, we talked about, value shopping when it comes to stock. Same thing with bonds. If you're going to buy any individual bonds or even municipal bonds, you want to make sure you're focused on quality and hopefully picking companies that won't have a disruption in a recession, or local municipalities that won't have a disruption in recession as well. Now, if you want to buy bonds directly, you can kind of go through Treasury Direct and take a look at some of these. This just gives you a quick reference here, kind of going through the first part of 2023, where yields have been. Savings bonds, the old EE bonds, were at 2.5%. Series I bonds, which are going to be your inflation hedge bonds, are at 4.3%. The 30-year Treasury about 3.6%, and the 10-year Treasury note at about 3.375%. And so these are some different options if you want to go out and buy them directly, or you can buy them through a brokerage account or an IRA through your brokerage account. And most of the time, you're not going to be able to do it through your 401k unless you maybe have a brokerage link there. But the EE and the I bonds, you have to go directly through the government. You can't do those. But Treasury bonds, Treasury notes, Treasury bills, you can get those. Let's say, for instance, we clear through Charles Schwab. So if you have questions about what are the rates across the board, we can give you those on a daily basis, and the benefit there is you can buy multiple bonds. You can trade them as well. So a lot of times, if you've got a 401k and you're looking at adding Treasury bonds to your 401k, if you don't have a brokerage link, most of the best options are going to be if you've retired or have a rollover option for a portion of that to roll it over to an IRA. Then you can do so through a company like Charles Schwab or others as well. And we can kind of help you through that process. Now, going to to the I bonds, these again are the ones that have been more popular. Now there are limits on these, but this is where you want to get your inflation hedge. And they obviously they bumped up quite a bit the last couple of years. They've kind of come down as well. But what they do is they set those every 6 months. There's a coupon that's been 0%. Now it's gone up to, I think, 0.9% as the base. And then based upon the CPI, they update that every 6 months to give you what the total annualized amount is going to be. So it changes every 6 months, but they annualize that. So if I take a zoom in here real quick, look at this. So if we look at that very first, right now, if you were to get one that's issued, I showed you before, 4.3%. So it has a fixed rate of 0.9%. Then the inflation adjusted CPI rate is going to bring it up to 4.3%. Now that will change whenever they release the new numbers in October. But if we go back, kind of look at the middle of that screen, or actually, if you go to the very end on the bottom right, you can see the rates were all the way down about in the 1% range. And then they actually climbed all the way up to 7.12%, 9.62% in May of 2022, and then have kind of come down a little bit since then. So what would have happened is if you bought that one in from May 2022, you get 9.62%. That paid that out for that 6 months. Then it dropped to 6.89%, now 4.3%. So again, they're on a 6 month changing period there as well. And you're limited to buying $10,000 worth of these per Social Security number through Treasury Direct, and then you can do another 5,000 with paper I bonds with your tax returns if you get that. So this is a quick glance at kind of what yield curves look like and where we are now. If we look at this, the bottom ones, the blue and the green, are going to be from 2020 and 2021. Then the middle is going to be 2022, and the red's going to be through the half of middle part of 2023. So the reason I put all these together is to kind of show you the differences of yield curves. The first two on the bottom are more of a normal yield curve, where you've got lower interest rates for the shorter term treasuries, the T-bills and T-notes, and then they get a little bit higher for Treasury bonds because you're going farther out there. That's a normal yield curve. Then you saw it kind of start to flatten during 2021 to 2022. And you can see where the short term started coming up and the long term started coming down to kind of meet themselves. And now we're at a point where halfway through 2023, looking a year back, we're at an inverted yield curve, actually, where you're going to get higher interest rates on short term than you would long term. Now, keep that in mind. That may be attractive, where you say, well, heck, if I can get 4% short term, only 3% long term, I'm going to want the short term. Well, if you get something that's only 2 years, it's only going to be for 2 years. So once that comes to maturity, you got to reassess that, and interest rates may be different at that point in time. We may be back into a normal yield curve. So again, things just to review and things that you can talk with us about if you're really trying to analyze your bond portfolio options. And like I said before, your 401k may or may not have that option. We work with a lot of companies, so we kind of know how to navigate through those. But for most 401ks, if you don't have that brokerage link, you're not going to be able to buy direct bonds. The best you'll be able to do is maybe have 3 or 4 or 5 bond mutual fund choices. But even with that, if you have questions, give us a call. We can run through those with you and help you review your 401k plan. And for most of you that may have retired and you still have your 401k plan, then you're going to have the option to roll that to an IRA where you've got more choices. Or even if you're still working, a lot of companies we work with give you an option 1 where you can diversify some of your 401k. They give you a percentage, maybe 20% of your portfolio. You can move out to an IRA, or maybe if you put in some after tax, that's usually transferable, where you can move that out to an IRA, or better yet, move it to a Roth IRA so it grows tax-free. And these are options where you can get into some of these different investment strategies as well. So for a lot of people we talk about, we've mentioned before the cash flow analysis. If you're approaching retirement or you've already retired, a lot of the companies we work with still actually, believe it or not, do have pension plans, and some have a lump sum. Once you retire, if you take that lump sum and you're not taking the annuity, you can usually combine that with your 401k, either in the 401k, or you can take both of them and roll them over to an IRA. So now you've got more flexibility where you've got thousands of choices to invest in on your own or with a company like the retirement group. And that transition from the 401k and or pension to an IRA, that's not a taxable distribution. There's no tax associated with it. It's just a moving from one tax deferred vehicle to another. But again, it gives you more flexibility and more choices. There's a few reasons maybe to stay within a 401k after you're retired. Maybe you're holding out for NUA treatment, which we can go over on a tax situation. Maybe you got an age 55 distribution, but we go through those in different webinars. But obviously, if you call us, we can walk you through personally as well. As I mentioned, even if you're working, you've got 10, 15 years ahead of you. If you have questions about how do I actually maximize my retirement, one of the best ways is to potentially build up after taxing your 401k, then convert that or roll that over to a Roth IRA. And that way it's going to start growing tax-free versus tax deferred. Let's say you've built up $50,000 of after tax in a 401k. And if you let that sit for 10 years, let's just simple math, assume it doubled in 10 years. That 50,000 of growth is going to be taxable eventually when you take it out from the 401k. Now, if you rolled it over to a Roth IRA, that $50,000 of growth, as long as you wait till 59 and a half, is going to be tax-free. So this is something to have a conversation with us about as well if you want to look at better tax planning for the future. And this is also a way where if you get that into a Roth IRA, if you want to talk about the direct investing options like the different bonds we talked about and others, we can go through that with you as well. But at the end of the day, the best way to do this is by running that cash flow analysis I mentioned and run through a detailed plan to see where you stand and figure out what we're trying to solve for. Right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about maybe as little as 10 minutes if you have the data already, or as much as 20 minutes helping you gather the data, different items like your 401k balance, pension, Social Security estimates, what you want to spend in retirement, we can put together that report. Give us about a week, and it'll be a detailed financial analysis to show you where you are and kind of analyze different retirement dates for you. And then from there, we can go and tweak it and be more specific and more detailed if you want to as well. But at the end of the day, there's a lot of different options to kind of review with this. And we work with a lot of different companies, and many of those companies we've been working with for 30 plus years. So if you have any questions about your 401k or your pension or anything, and how some of these different, the value philosophy or bonds can play into your portfolio, just give us a call. We'll be happy to go through that with you. And I'll leave this on the screen and we'll get in some Q&A in a moment. But if you have questions, call us at 800-900-5867. Or you can email us at info@theretirementgroup.com. And there's a couple QR codes here. You can schedule an appointment with myself or one of the other retirement group advisors by going to this and getting into our calendars. Usually those calendars are about a week out. So if you need something sooner, give us a call. And if you'd like to also follow us on our LinkedIn page where you can go in there and get your specific company LinkedIn information, we'll give you updates on future webinars specific to your situations. So, all right, I'm out of breath. Samantha, did we get anything come through as far as the questions?
Yes, we actually got some really great questions. First one, Wesley, could you explain the differences between Treasury bills, notes, and bonds and how interest payments and the way they are sold works?
Okay. So if we go back to that yield curve slide that I was giving you, that's kind of the best way to look at it. We talked about the short term, midterm, and long term. That's really what they are. Treasury bills are short term. They're what's issued for the a couple weeks out to a year out. Treasury notes are midterm. They're 2 years to 10 years, and Treasury bonds are usually issued 20 and 30 years. So now what happens is that you could have a Treasury bond that was issued 29 years ago, and it's still a treasury bond. You buy it, but it's only got a 1 year left of maturity as well. So you get into the secondary market of buying those, that's where it's a little bit different. But those are all issued directly by the Treasury. So you can get those through Treasury Direct, or again, you can buy them on the secondary market. Maybe somebody bought a Treasury bond 10 years ago and they want to sell it, or that's where you can go out there and buy them on the secondary market. So you can look at the combination of those as far as where they are. But typically the yield's going to they're going to merge to very, very close.
All righty, thank you. Number 2, if I want to buy U.S. government bonds, where can I purchase them directly?
Okay, I guess I just said, so Treasury Direct is where you can do that. They've set up a electronic system to do so. And if you want to do the EE bonds or the I bonds, you have to go through Treasury Direct. If you want to do T-bills, T-notes, T-bonds, you can do that through Treasury Direct as well. But also, like I said, we clear through Charles Schwab. So if you want to buy them through a brokerage firm, you can do so as well. A lot of times that's going to depend upon the size of assets you have, and it's going to make it easier where you can buy multiple bonds in one place, in one account. You can do the same with Treasury Direct, but it's just that it's up to you which you prefer. But there are options between both choices on there. And then I think I mentioned before the savings bonds, the E bonds, and the I bonds, those are both limited to $10,000 per person. And then on the I bonds, you can do an extra $5,000 if you've overpaid your taxes and are getting a refund, want to use that as well.
Nice. Okay. Third, how do interest rates impact the prices of treasury bonds I already own?
Okay. I guess I touched on this too when we were talking about the yield curve, I think. So what's going to happen is, if you already own treasury bonds, a treasury bond is going to give you a fixed payment, whether it be a treasury bond, a corporate bond, a municipal bond. The answer is going to be the same for all these. Let me give an example. Let's assume you went out there and you got a 20-year bond that was paying 4%. Okay. So what's going to happen is you're going to have 4% coupon. Let's say it's a $1,000 par usually. So you're getting $40 a year put in to your account. And what's going to happen is if you say, okay, well, halfway through that, I want to sell it. I don't need any more, or I need the money. What's going to happen is the secondary market is going to tell you what that price is worth. So if somebody go out there and buy a similar bond with a similar current maturity for 5% instead of 4%, they're not going to want yours they're not going to pay you the same amount you paid it. So they might have to give you a discount. So instead of giving you $1,000 back, you might get $985 back or something like that. So you could lose money on there. Or the flip side could happen if you went out and bought bonds right now or over the last year when inflation was high, and then we get into a recession and interest rates go down, people are going to pay you a premium if you decide to sell your bond. So that's where interest rates kind of play into the aspect of it. It's not going to change the coupon. The coupon's fixed, unless you're looking at tips. The coupon's fixed, but what's going to happen is whatever you're selling that for is going to change the principal and what people are willing to pay for it.
Alrighty.
Oh, sorry, and just add, but if you're not selling it, you just simply hold its maturity, you're going to get your $1,000 back. There's no issues. It's only if you go out there and want to sell it. And that's where we had that issue with the banks in early 2023, because they were sitting on a bunch of really low yield treasury notes and treasury bonds and were forced to sell them at a discount.
Okay. Speaking of tips, last question. Can you explain how inflation impacts treasury bonds and how tips can help to hedge against inflation?
Okay. So the inflation kind of goes hand in hand with what I just talked about, the interest rates. Obviously, as inflation rises, so do interest rates and the requirement for higher yields on things. So that kind of just piggybacks that answer. If inflation increases rates, then it decreases the principal. So if we go back to 2022, we saw, I'm going to call it an anomaly, but it was the worst year we've ever seen for bond markets because we saw the Fed raise the rates quicker than they've ever raised them in the history. If we go back historically to the 30s, usually when we have a negative bond year, we're going to have a positive return the next 18 to 36 months. Not always. In the 60s, there was kind of a leveling off. But what happened was those interest rates moved so quickly because of inflation that people didn't want those old bonds anymore. So that drove down their prices. So again, kind of back into those interest rates. For tips, it's a little bit different. Those also got hammered last year. because they just can't keep up with how quick the inflation went. But the way a tip is done, it's issued by the Treasury, so it's kind of like a regular Treasury bond would be. The difference is the coupon. It's the principal can be adjusted with CPI adjustments. So let's assume you go out there and have one that's paying. They're going to pay a lower yield. Let's say it's paying 2%. And if inflation's flat, if you never change, it's going to pay that 2% all the way throughout maturity, and your $1,000 par is going to stay the same. But if inflation goes up, then what's going to happen is they're going to use the CPI in order to account for that, and they're going to adjust your principal. So now your principal may go from $1,000 to $1,010 or $1,015, and you still get that same coupon note, that 2%, but now it's off of a higher par value, and that's where that happens. Now, on the flip side, if there's deflation, then they're going to reduce that as well, but it can never be reduced below what that initial principal was. So those are going to be, over a long term, a good inflation hedge. Over the short term, it depends. We saw interest rates spike so quickly, there was nowhere to hide. So they got hammered last year as well. They didn't get hammered as much as a regular Treasury bill. So it did do what it was supposed to, but from a slow, steady inflationary pressure standpoint, tips can be a part of the portfolio, but it's something to review one-on-one.
Okay, thank you. That was it for today, Wesley.
Okay, well, I thank everybody for joining us. And like we said before, we've worked extensively with a lot of companies, and probably the company you work for right now. But that doesn't mean that we're endorsed by them or employed by them. But should you have any questions, want to dig into details, don't hesitate to give us a call at 1-800-900-5867. Thank you, and you have a great day.
Thank you. Bye, Wesley.